In this video, I want to talk about why making small cap stocks a part of your portfolio could make sense based on recent stock market valuations. Welcome back. This is episode 171. In this week's episode, I'd like to talk about constructing your investment portfolio and specifically if you should include small cap stocks in the makeup of your portfolio. And if you're new to the show, my goal is to teach you how to save for retirement, how to plan for retirement, how to invest for retirement, and how to pay less taxes in retirement. And if you want help on how to do that beyond these videos, consider taking my comprehensive retirement planning course, Retirement Readiness Review. It's an online course where I will walk you through all the steps in planning and managing the perfect retirement, including constructing your retirement portfolio. So head over to retirewithryan.com/on-demand to learn more. So as the stock market tries to find its footing after two recent bad months of performance in August and July, now may be a good time to consider adding small cap stocks or small cap stock funds to your portfolio. Currently, large cap stocks, which are the largest companies generally found in the S&P 500 and the NASDAQ, are having a very good year. The S&P 500 is up 13% on the year, and the NASDAQ is up 39%. Those are impressive returns for the year, and people may be wondering if we're going to struggle to go higher from here. A lesser followed area of investing is known as small cap stocks, could offer you greater upside potential than the S&P 500 and the NASDAQ. Small cap companies are companies with a market capitalization or valuation of roughly $2 billion. So to determine market capitalization of a company, you simply multiply the stock price times the number of shares, and that gives you the valuation. Now, $2 billion is still a lot of money, but that pales in comparison to some of the biggest large cap names. For example, Apple has a market capitalization of $2.7 trillion. Microsoft has a market capitalization of $2.45 trillion, and Google or Alphabet has a market capitalization of $1.77 trillion. As you can imagine, a small-sized company can offer more growth potential than a larger company because it's much easier for that small company to grow at a faster rate than it would be for a larger company like Apple to experience rapid growth. Now, I'm not picking on Apple, but just how many more iPhones, earpods, and iPads can they sell? However, this greater growth potential that small caps offer also comes from greater potential volatility and larger losses than a large cap company. Large companies can weather an economic storm better than a small company can. In the case of Apple, as I mentioned, they have multiple product lines and revenue streams, so they can weather an economic downturn a lot better, whereas a smaller company may only have one product or one revenue stream. So if that product or revenue stream has a problem, their stock will take a big hit. Over the long term, small cap stocks have outperformed large cap stocks. Since 1926, which is almost 100 years, small cap stocks have averaged an 11.57 per year return through the end of 2022, and large cap stocks have an average return of 9.57%. However, that outperformance has come with much larger fluctuation of returns or standard deviation. So if we look more closely at recent times over the last 10 years, small cap stocks as measured by the S&P 600 have earned 10% over the last year, I should say, and large cap stocks have gained 21.62%. Over the past 5 years, the S&P 500 has gained about 10% per year, and the S&P 600 has gained about 3.7% per year. If we look over the last 10 years, the S&P 500 has an average return of about 12%, and the S&P 600 has averaged about 8%. So in recent terms, small cap stocks have underperformed large cap stocks when compared to their long-term returns. And this underperformance has led to an undervaluation of small cap stocks. Currently, small cap stocks trade at a price-to-earnings ratio of 13, whereas the S&P 500 is trading at a price-to-earnings ratio of 21. And since 2010, small cap stocks have generally traded at a PE ratio of 18, and the S&P 500 is generally traded around 20. So that means there's a potential buying opportunity in small cap stocks. But that doesn't mean that markets are rational. The S&P 500 could continue to trade at or above its historical PE average, whereas small cap stocks could also continue to trade below their average. However, if small cap stocks are recognized at a more fair valuation and the valuation normalizes, this presents a good growth opportunity for growth in small cap stocks, potentially over large cap. Now, you can play small cap stocks in a few ways. You can purchase individual small cap stocks. That'd be a pretty intensive thing to do. Or you can just use stock index funds or stock mutual funds, actively managed funds, to purchase small cap stocks. My personal preference is using index-based funds or ETFs. That's something I talked about last week, about how you can lower your expenses inside your retirement accounts. And two of the more popular small cap ETFs are SPSM, which is the Spider Portfolio 600, and IWN, which is the iShares Russell 2000. So if we look a little bit under the hood, IWN, the Russell 2000, has an annual expense ratio of 0.19, and small cap S&P 600, the Spider S&P 600 SPSM, has an annual expense ratio of 0.03. So both are very low, but they have some subtle differences. SPSM is just 600 stocks, and the Russell 2000, just like its name, is 2,000 stocks. And you would think more is better, but in the case of the Russell 2000, it's estimated that about 41% of the stocks in the Russell 2000 are unprofitable. So that unprofitability can lead to some underperformance, whereas most of the stocks in the S&P 600 are actually profitable companies. So if we look at returns over the last 3 years, SPSM has an average annual return of 12.1%. And if we look at IWN, it has an average annual return of 7%. So that reduction in the unprofitable companies has really helped the S&P 600 perform better than the Russell 2000. So this is something you could definitely implement on your own. If you're using a brokerage account, it's a lot easier. If you're doing it through a retirement account, you'd have to look through your retirement account to see what individual funds you can choose from. And if they offer a small cap index fund, that is an option you could consider. Or you could also consider opening a brokerage window, as I've talked about, through your retirement account to give you greater access to individual ETFs or index funds. So definitely worth taking a look at your overall asset allocation and figuring out if small cap funds or stocks make sense to add to your allocation to give you some greater upside potential from here. Don't forget to head over to retirewithryan.com to propose your listener question, or if you want to download a free chapter of my book, Fiduciary, which will be coming out in the next month, you can download a free chapter. Thanks again for watching and tuning in, and I hope to talk to you next Wednesday. Take care.